Nvidia just posted the best earnings in its history. The stock fell 14%. That's not a panic sell-off, that's a signal, and it's coming from people who knew exactly what those numbers said. Something is moving underneath this stock that the price alone doesn't explain, and it's not what most people are focused on. We're mapping this across 8 charts, institutional filings, Capex commitments, competitive data, to show you exactly where the smart money is positioned right now and why it matters for your portfolio. Welcome to the channel, where we break down crypto and quality stocks using clear, data-driven charts to track where institutional money is moving and what that means for your portfolio. Everything here is analysis based on public data. What you do with it is entirely your decision. Let's go through this, one chart at a time, starting right here with the sell-off that genuinely broke logic in February 2026. Nvidia just reported the best earnings quarter in its entire history, and the stock dropped 14%. Look at this chart. The x-axis runs from February 10th through March 6th, 2026. The y-axis shows Nvidia's daily closing price. The green line on the left is the pre-earnings run-up, climbing steadily from $188 on February 10th all the way to $195.56 on February 25th, the day Q4 fiscal year 2026 earnings dropped after market close. Then the dashed vertical line hits, and the red line begins. By February 27th, the stock was at $177. By March 6th, still $177.82, a 14.2% drop from peak to trough. And notice something, the stock didn't bounce back, it just sat there. Now, here's the question every smart investor should be asking. If the earnings were the best in company history, why did the stock fall? And more importantly, what does that tell us about where it goes next? The answer lives in the next 7 charts. Keep watching. This is the revenue chart, and it is genuinely staggering. The x-axis shows 8 consecutive quarters from Q1 fiscal year 2025 through Q4 fiscal year 2026. The left y-axis measures revenue in billions. The right y-axis, the gold line, tracks data center revenue as a percentage of total revenue. The bars are split 2 colors. Bright green is data center revenue. Darker green is everything else. Gaming, professional visualization, automotive, all of it. Look at this progression. Q1 fiscal year 2025, $26 billion total. Q4 fiscal year 2025, $39.3 billion. Then watch what happens in fiscal year 2026. Q1, $44.1 billion. Q2, $46.7 billion. Q3, $57 billion. Q4 fiscal year 2026, the quarter that just reported, $68.1 billion. In one single quarter, $68.1 billion. And that gold line on the right, data center as a percentage of revenue, just hit 91.5%. Nearly the entire company is now a data center infrastructure play. Gaming, once Nvidia's core identity, is basically a rounding error now. But here's what really matters. This isn't a one-quarter spike. This is 8 consecutive quarters of acceleration with no slowdown visible. The trend line doesn't bend, it climbs. So why did the stock fall after this? Because the market priced in perfection and then asked, what comes next? And that question leads us directly to chart 3. Here's where things get genuinely exciting and a little bit mind-bending. This chart shows capital expenditure, the money the biggest tech companies on Earth plan to spend, comparing 2025 actual spend against 2026 guidance. 5 companies. Blue bars are 2025, green bars are 2026. Amazon, $131.8 billion in 2025, guiding to $200 billion in 2026. That's plus 52%. Alphabet, $91.4 billion to $180 billion, plus 97%, nearly doubling in 1 year. Microsoft, $88.7 billion to $120 billion. Meta, $70 billion to $125 billion. Oracle, the sleeper, going from $21.4 billion to $50 billion, plus 134%. Total 2025 spend, $404 billion. Total 2026 guidance, $677 billion. That's a 67% increase in a single year. Now, look at the annotation at the top of the chart. 75% of 2026 spend is directed at AI infrastructure, and Nvidia captures approximately 90% of AI accelerator revenue. Run the math. 75% of $677 billion is roughly $506 billion going to AI infrastructure. If Nvidia captures 90% of that accelerator spend, that is a demand pipeline that dwarfs anything visible in the current revenue run rate. This is why the post-earnings sell-off looks like a buying signal to institutional capital. The fundamentals aren't weakening. The demand is being locked in years in advance. But wait, not every institution sees it that way, and that's where the story gets complicated. By the way, if this kind of institutional data tracking is your thing, I share a lot more of it in my Facebook, TikTok, and X accounts. Find the links in my YouTube channel. It's where I post what doesn't make it into the videos. Worth checking out. Now, back to the 13F filings. This chart shows the top institutional buyers of Nvidia shares in Q4 2025, ranked by shares added. The x-axis goes from 0 to 5 million shares. The bars represent 5 major institutions. Point72 Asset Management, Steve Cohen's fund, added 2.75 million shares. Their Nvidia portfolio value is now $1.86 billion. That's a 38% increase from Q3, a massive conviction bet. Bridgewater Associates, Ray Dalio's firm, added 1.354 million shares. Portfolio value, $721 million, up 54% from Q3. Then the numbers drop significantly. Soros Fund Management added 120,000 shares. Third Point, Dan Loeb's fund, added 100,000 shares. ARK Investment, Cathie Wood, added 93,000 shares. 8,541 institutional filers held Nvidia in Q4 2025. It's among the top 3 most held tech stocks on Earth. And the top 2 names, Point72 Asset Management and Bridgewater, aren't small retail funds making emotional bets. These are sophisticated, data-driven institutions with billions in research infrastructure. They bought the sell-off. But here's the chart that tells the other side of the story, and it's just as important. This one requires a moment to absorb. Coatue Management, Philippe Lafon's fund, was one of the earliest and largest institutional believers in Nvidia. The x-axis here shows quarters, from Q1 2023 through Q3 2025. The y-axis shows shares held in millions. The single green bar on the left is Q1 2023, Coatue's peak position, 59.8 million shares. Then the red bars begin. Q2 2023, 45.4 million shares, a small reduction. Then watch the cliff. Q2 2024, 13.8 million, down 72% from peak. Q3 2024, 10.1 million. Q4 2024, 10 million. Q1 2025, 8.5 million. Q3 2025, 9.6 million. That subtitle is not subtle. 83% reduction from the Q1 2023 peak. 10 consecutive quarters of selling. Now, is Coatue wrong? Not necessarily. They may have simply done their job, bought early, rode the wave from much lower prices, and rotated profits into the next opportunity. That's how professional capital management works. But this chart creates a real tension when placed next to chart 4. Point72 and Bridgewater are aggressively buying. Coatue has been systematically exiting for over 2 years. 2 groups of smart people, same stock. Completely different conclusions. Who's right? The answer might depend on one very specific risk that emerged in February 2026. This chart is split into two panels. The left side is a strategic timeline. The right side shows AI accelerator market share data. Look at the timeline first. February 17th, Meta confirms a massive Nvidia deal. Millions of Blackwell NVL72 GPUs, a huge, unambiguous commitment to Nvidia. Then, 7 days later, February 24th, Meta signs a $60 to $100 billion deal with AMD, the MI450, Helios rack-scale architecture, a completely different vendor, 1 week apart, both confirmed. Now look at the market share panel on the right. In 2025, Nvidia held 86% of the AI accelerator market share. AMD held 9%. In 2026 projections, Nvidia 82%, AMD 15%. 4 percentage points. That sounds small, but when we're talking about a $675 billion annual spend market, 4 points is tens of billions of dollars. Here's what this actually means. Meta isn't abandoning Nvidia. They're buying from both, but the dual vendor strategy signals that hyperscalers are deliberately building alternatives. They don't want to be dependent on a single supplier for the most critical infrastructure on the planet. This is the first credible structural threat to Nvidia's dominance, not a tech failure, not a product miss, a customer strategy shift. And yet, there's a reason most analysts think Nvidia survives this. That reason has 5 million data points behind it. This chart has two components. On the left, a bar chart showing Nvidia's networking revenue by quarter from Q1 fiscal year 2025 through Q4 fiscal year 2026. On the right, two data panels showing developer and platform market share. Let's start with the bars. Q1 fiscal year 2025, $3.17 billion in networking revenue. The next few quarters stay flat, around $3 to $3.7 billion. Then, fiscal year 2026 hits. Q1, $4.6 billion. Q2, $5.57 billion. Q3, $8.46 billion. Q4 fiscal year 2026, $10.98 billion, plus 263% year-over-year. Nvidia's networking business, NVLink, Spectrum X, is now nearly an $11 billion quarterly business on its own. This is the part most retail investors completely miss. Now the right panel. 5.1 million CUDA developers as of 2025. Compare that to AMD's ROCm platform, approximately 5% developer share. CUDA holds 92% of GPU compute platform share in AI and high-performance computing. This is the moat, not the hardware, the software ecosystem. Switching away from Nvidia doesn't just mean buying different chips. It means retraining millions of developers, rewriting millions of lines of code, migrating an entire technical stack that has been CUDA native for over a decade. Meta's AMD deal is real. The competitive pressure is real. But this 5.1 million developer number is the reason Nvidia's 82% share floor looks more like a floor than a ceiling. And if you want to track whether that moat is holding, there's a catalyst coming very soon that the data says you should watch very carefully. This is the final chart, and it is quietly the most actionable one in this entire video. The x-axis shows two datasets side by side, the 5-year average post-GTC return from 2021 to 2025, and the specific GTC 2025 return from March 18th of last year. The y-axis is 30-day return percentage. The green bar on the left, in the 30 days before GTC, Nvidia averages a positive 7% return. Anticipation drives the stock up. Then the red bars. In the 30 days after GTC, the 5-year average is negative 7%. In GTC 2025 specifically, it was negative 14%, and the number in the top right corner, 88%. 88% of the time over the last 5 years, Nvidia falls in the 30 days following the GTC keynote. Think about what that means. Jensen Huang takes the stage. He reveals next-generation hardware, roadmaps, partnerships. The stock often rallies into the event, and then, almost without exception over half a decade, it pulls back. This is the classic buy the rumor, sell the news pattern, institutionalized, repeating. GTC 2026 is on the horizon, and if the historical pattern holds, the stock that already fell 14% after earnings may face another headwind in the weeks following the keynote. If you want to be the kind of investor who tracks institutional positioning before the narrative reaches the mainstream, that's exactly what this channel exists for. The data is always here before the crowd catches up. Remember, this analysis is not financial advice. Every situation is different. Do your own research and talk to a professional if you need guidance. Here is the core truth that all 8 of these charts point to. Nvidia's fundamentals are never stronger. The demand pipeline is never been more locked in, and the institutional divergence, buyers like Point72 and Bridgewater on one side, systematic sellers like Coatue on the other, tells you this stock is not for the undecided. The sell-off was real. The competitive pressure is real. The GTC pattern is real. But the $675 billion in hyperscaler Capex, the 5.1 million CUDA developers, and the $11 billion networking quarter, those are also real. The question isn't whether Nvidia is in trouble. The question is, are you reading the data the smart money is using, or are you reacting to headlines? That's the difference between tracking institutional capital and following the crowd.